Hello everyone, this is Ted Bauman here, editor of the Bauman Letter here at Banyan Hill Publishing. I'm up in Virginia this week visiting relatives, having a cup of coffee out here on the deck. It's kind of gloomy today overhead, but it's still a beautiful part of the country. If you ever get a chance to visit the Rappahannock River region, that's known as the Northern Neck. The other side is called the Southern Neck. It's quite historical, quite beautiful. In fact, George Washington's wife, Mary Ball Washington, was born only a few miles from where I'm sitting. Anyway, today I want to talk about something a little less pleasant, and that is the possibility of a market correction. Now, those of you who've been invested in the stock market for some time will know that over the last couple of years we have experienced some significant periods of correction, and I want to show you a chart that illustrates when that has happened. The first time was at the end of January 2018, when the market nosedived after having experienced a tremendous run-up during the first few weeks of that year. Now, as you may recall, that was precipitated by the Congress passing a new tax law, which excited everybody, but then stocks took off like a rocket, and people began to feel that there was an overvalued situation, and so they sold quickly. The market didn't return to those highs until that summer, after having experienced another big drop later on. But by July, it had returned to its previous highs, only at that point, as you can see, to drop in September by a very significant amount, then to recover slightly, and then in December of that year, wow, what a big drop we saw that time. So that was a scary time for investors, but as you can see, the market resumed its upward march during the course of 2019. It corrected pretty significantly in April. It did so again in July. Now, ever since then, and there was a smaller downtick in September, all of these really related to the Chinese-US trade conflict, by the way. Ever since really October last year, we have seen a big uptick in the markets. We saw a brief downturn earlier this year, as you can see, at the end of last month, but since then, the markets have recovered significantly. Now, if you were to draw a line sort of that shows the overall trend of the market throughout this period, it would pretty much end up being a straight line showing reasonable growth, quite good growth actually, over the period. So in the midst of all of that, however, the market did dip down only to recover. Now, the big question is, are we setting ourselves up for another situation like that? And in anticipation of that, let's talk about what the market thinks. Now, here's a chart that shows investor expectations of the market's current valuation levels and the possibility of a recession. On the left-hand side, you could see that in 2019, the number of, or the percentage of major investors, institutional investors, who think that the market is significantly more overvalued, that stock prices are higher than they should be, reached a high of 73%. That's the highest figure it has been in the last 5 years. On the right-hand side, you can see that the number of people, or investors rather, who think that a recession might occur within the next year is about 36%. Over the next 1 to 2 years is 35%. And over the next 2 to 3 years is 11%. So there is probably, fair to say, a significant concern level that a recession is on the way within the next 24 months. That's nearly 70% of the people who responded. Now, one thing to remember is that a recession is not necessarily the same thing as a stock market downturn, and vice versa. I wonder sometimes when I see these kinds of statistics whether the people who are recording them or reporting them are actually thinking about a recession in stock prices as opposed to a recession in the economy. Remember, you can have a collapse of stock prices without any underlying problem in the economy, and vice versa. Now, the question is, how reasonable are these expectations? What do I think? That's what I'm here to tell you. Well, first of all, I think it's fair to say that the stock market is overvalued. I think across the board, investors have definitely put a lot of money into stocks, or rather not a lot of money, but they've put money into stocks in a bullish mode. In other words, they have consistently bid up the prices of stocks. Now, what's an interesting fact is that there, at the same time that the stock market has been increasing in value like this, we've also seen a very significant flow of money into bonds, which are considered safe haven assets. That's why bond yields are at historical lows. So at the same time that investors are bidding up stock prices, they're also moving money into the bond market. Historically, that's a very unusual situation. Usually investors either put money into bonds or they put them into stocks. Here what you have is a tendency for investors to do both. Now, how do you explain this situation and what does it mean for the potential for a correction? Well, first of all, remember that there's a lot more money out in the economy than there was 10 years ago. The so-called quantitative easing program by the Federal Reserve and other banks during the aftermath of the financial crisis of 2008 has pumped a massive amount of liquidity into the markets. And that liquidity has not found its way into the hands of Main Street Americans or Main Street Europeans. It's found its way into the balance sheets of the big banks. And those banks have looked for investment opportunities. Now, there's two ways that big institutions like that can approach their investment activity. One is to try to maximize their gains through trading in the stock market. The other is to look for safety as a backstop against a potential financial crisis. Because of the regulations put in place after the 2008 crisis, the big banks, who have control over most of the liquidity that has gone into the markets, have tended to opt for safety. They tend not to trade aggressively on their own accounts the way they used to do prior to 2008. And that's by design. It makes the banking system much more stable than it used to be. Now, one of the things that we are trying to understand is how that impacts the potential for volatility in the stock market. My take is that the stock market is probably being driven by lower volumes of trade. By the bulk of money is not in the stock market, it's in the bond market. Something like $10 trillion has flowed in the last 10 years. But there's enough money in the stock market to move prices rapidly. Remember, it doesn't matter whether there is a lot of money or a little money in the stock market. The only thing that matters is buyers and sellers on a given day to move stock prices. Even if there are very few of them, they can still move prices. In fact, when you have low volume, you often have higher volatility because you don't have as many buyers and sellers to balance out the peaks and troughs. Now, my take is that I think that stocks are overvalued. I think that they are looking for a way to moderate their rise. I talk about stocks as though they have their own volition, that they can do what they want on their own. Of course not. It's the traders, it's the investors who are thinking this way. I think it's like a game of musical chairs. Everybody wants to know when to get out, but nobody knows when the whistle is going to be blown or when the music's going to go off. Now, my take is that if you look at the right sectors, if you look at the sectors that have inherent strong underpinnings in terms of revenue growth, earnings growth, profit growth over the next year or so, I think it's a good bet to hang on to those stocks. More speculative stocks, and in the past I've spoken about Tesla last week, also some of the IPO stocks that have come out recently, the loss-making companies like Uber and Lyft and others, will probably correct quite significantly in a downturn because they're not currently delivering profits. That's because they're not fundamentally driven stock prices. They're driven by speculation. So my message overall is, yes, I do think that we're entering risky territory with the stock market as it is right now. I do think that there is a risk of a correction. The market could be said to be looking for an excuse for one. So far, the Wuhan virus has not provided that excuse. But as we get closer to the election, I think that might actually be a trigger. If it turns out that Bernie Sanders becomes the nominee for the Democratic Party, I would strongly expect the stock market to pull back out of concern for the possibility that he might be elected. Whether those concerns are justified or not is another question. The point is that it's clear that the investor class, the big investor class, does not want to see him president. Now, that could be the thing that triggers it. So as we come close to the nominating conventions in June, July, that's when I would tend to look for increased volatility. Question is, what strategy do you adopt? Well, my strategy with the portfolios that I run for the Bauman letter is to look at stocks that have appreciated significantly over the last period, our holding period, and then to take profits on those stocks if I anticipate a sudden move downward in the market before it happens. Now, note that when I say take profits, I don't mean sell them all. I mean sell the proportion of shares in your stocks or by value that reflects the amount that you've gained. For example, if you have a stock that's gained 50%, then sell 1/3 of your shares to take you back to the original value of your holding. That way, you've locked in 50% of your gains. You have the same amount of money invested in the stock that you did when you first started, after you sell the 50%. And then at that point, if the market corrects, it'll be correcting relative to your original investment amount, and you won't run the risk of losing the money that you've already gained, or rather the value that you've gained in those stocks. Now, the question is how to know when this is going to happen. And this is where I think it's important to keep reading and keep watching something like the Bauman Daily, because that's precisely what my colleague Clint Lee and I are looking out for at all times. We're always looking for the possibility of taking profits on stocks that we've gained, and then letting those stocks ride back at their original values, which means fewer shares but at a higher price point, and in order to reap potential further gains, but not to run the risk of losing what we've already got. So that's my message to you today. The market thinks that a correction is coming. I tend to think that it could be too, and I think it could be triggered by the political cycle in the United States. I think that there is volatility inherent in the current stock market because of the amount of money that's shifted to bonds, leaving less money with higher volatility in the stock market itself. And therefore, I think it's important to keep an eye on when it's time to take profits, but not to sell everything. That's the important thing. You don't just, it's not either or, on or off. You take profits, you go back to your original value of your investment, and then you let it ride again. And if the market dips, it will recover, as it always has, and always probably will. Anyway, this is Ted Bauman here, signing off from Rappahannock River here in Virginia. Don't forget to check out other videos here on YouTube. As you can see, there's a playlist of numerous different types of videos that I've posted, including an interesting series on competition policy in the United States. So, signing off. I'll talk to you again next week.